So Dan, maybe you could go ahead and start out with interest rates.
Thanks, Mark. Welcome, everyone. As I'm sure everyone here is aware, the Fed continues to battle inflation by raising interest rates. They've now raised rates 10 times in the past year, up 500 basis points or 5%. And there's potentially two more 25 basis point rate hikes on the horizon. This is the fastest rate hike cycle in recent US history. However, in June, the Fed paused their rate hikes, which could be a sign that we are nearing the end of this rate hike cycle. Although the speed of this hiking cycle was much faster than predicted, and it caused some market turmoil, it is working to reduce inflation. So looking at this chart of the CPI, it shows that inflation has been dropping steadily since June 2022, when it peaked at over 9%. And in May 2023, inflation was at 4%, its lowest level in 2 years.
Thanks, Dan. Yeah, now looking forward, obviously there's been some progress made here. There's also a lot of data showing that the downward inflationary trend is going to continue. One point to note, oil price per barrel has been dropping. We're currently back down to December 2021 pricing. And then as you can see by this headline, why economists say it's a near certainty that housing inflation will soon fall. This is largely due to shelter being a lagging indicator. It's also arguably one of the most critical variables in CPI, Consumer Price Index. And it's lagging because CPI measures contract rent, that is the rents that are in place across the US, and not necessarily current market rents. And so the short takeaway here is that a lot of the data regarding rents and shelter is actually not up to date or current. And we are seeing that rents are still increasing in 2023. We will talk more about that in a moment. But the pace of the rent increases that we're seeing currently in 2023, which is a big component of inflation, is a lot lower than the pace in 2021 and 2022. And that's what's really keeping CPI down. When you can see this chart here, I think this helps kind of clarify what we're trying to mention. The green is the year-over-year change in CPI rent. And you can see it's just starting to plateau. In May-ish of 2023, we're starting to see it go down. And so this is where the headline comes from, where it's likely that inflation will continue to drop. Now let's talk about some of the real estate trends we're seeing. Before we get into data, just want to bring everyone up to speed. Generally speaking, we saw skyrocketing rents and pricing for most real estate sectors in late 2020 through the end of 2021. Rents were up over 15% annually. Some markets saw over 30% increases in rents. And then in early 2022, the Fed began raising interest rates. And the result was some weakening. We saw higher vacancy. You can see this chart here in orange. It's showing month over month change in US market rate apartment occupancy. So more vacancy and less occupancy through 22. And we also saw higher bad debt, which is a tenant's inability to pay rent, much slower rental rate growth. And then when we look at the end of this chart, the last several months through 2023, apartment leasing demand is actually back to very solid levels again. Vacancies remain steady at just over 5% since the beginning of the year. This is in line with long-term trends. And really what we're seeing is the vast majority of predominantly market rate apartment renters continue to pay rent on time. Rent collections in May came in at nearly 96% nationally. So just some positive trends to start the year. Definitely a bit of a change from an occupancy and a rent standpoint over 2022. Now, looking back at 2022, we also saw asking rents at apartments drop near the end of 2022. You can see that here. There's these four lines for the last 4 months of the year where the rents have actually gone down. This is the month-over-month change in the same unit, same apartments. But meanwhile, the rents have gone up for the last 4 months. And so we're just seeing a little bit more resilience here. It's also good to see that rents remain 25% higher today than they were pre-COVID in 2019. Just some points showing some of the resilience of the housing market, which is a big component of the economy and inflation. Dan, why don't we shift gears and have you talk about some more inflation numbers here?
Yeah, it's important to remember that inflation pushes rental rates higher. And as this chart shows us, May rent growth across the US was up 2.6% year over year. Now this growth, although it was positive, is the lowest since March 2021. However, on the bright side, it's now back down to more sustainable levels. And I think it's important to note that the average rent for single family homes rose to an all-time high in May at $2,100 a month.
Yeah, thanks, Dan. Really what we're seeing strong fundamentals of supply and demand weighing heavily on the real estate market. It's something we've been tracking for many years, and we continue to face a significant housing affordability crisis in the US. This has only gotten worse since interest rates began rising. Supply remains very low while demand remains strong. And these are fundamentals that are very important today, really finding homeownership out of reach for many Americans. You've also got a lot of folks who have, low interest rates on their homes, 3%, hesitant to sell and jump into a higher rate, call it 6.5%, 7%. That's relative same trend for commercial real estate. Many owners sitting on the sidelines. So really supply constrained. A lot of people are waiting to see what's going to happen. There was a study done by Harvard. They looked at average monthly mortgage payment from March of 2022 to March of 2023. The cost has gone up by 30%. That's in 1 year, really making this point known here that buying a house is the hardest it has been in nearly 30 years. Housing affordability is at its lowest levels since 1996. Another point kind of adding to this commentary, the salary needed to afford a typical US home is at an all-time high, where it's about $117,000 a year in order to afford the monthly payment. Okay, let's look at commercial real estate pricing. Now, we have seen pricing come down. This is evident in higher going-in cap rates when we're analyzing deals. And if we look at this chart from Green Street Advisors, it shows that commercial real estate prices are down about 15% from last year. Another data source, Real Capital Analytics, is showing the same time period a little over 11% down. Now, we also look at this chart a little closer, and what we're seeing here is the change in commercial property pricing for the past 7 years. And you'll see the leaders that have grown the most are industrial, manufactured homes, which are mobile homes, self-storage, and then in green down here, apartments. And then if you look more closely in just the last couple quarters, you see that industrial is actually starting to tick back up again, while manufactured homes are relatively flat, and the same with self-storage and apartments. Now, an important point, we're going to talk a little bit more about industrial as it's a selected asset class for our fund, but our operating partners on our triple net industrial portfolio that we've targeted for investment, they've been acquiring properties at about 200 basis points higher cap rate than what they were paying in 2021 and 2022. So that's a favorable trend. It really makes it an attractive time to invest in some of these assets. Dan, I'll shift over to you regarding recession.
Yeah, it's a question on all our minds. Will the US enter a recession? And of course, nobody knows for sure, but a few recent headlines and indications of where we are. First, HSBC just predicted that a US recession is coming this year. They do expect it to be more mild than past recessions, only decreasing GDP by 1 to 2%. versus over a 4% decline in 2008. Meanwhile, corporate bankruptcies have risen due to heavy debt loads and difficulty refinancing with higher interest rates. This could ultimately lead to an increase in unemployment. And on that note, recent data point, payrolls rose 339,000 in May, much better than expected, showing the resilience in the labor market, and unemployment rate at 3.7% in May, the lowest since 1969. Another indicator could be copper's recent surge up to over 12% in the past month, and it could signal some bright times ahead. It's a leading indicator just because it's input into so many things being produced.
Yeah, thanks, Dan. So, we have some more headlines. We'll run through them quick. Home price declines may be over from SMK Case-Shiller, and these are all within the last month. Very current information that we're sharing with you. This one, the housing market suggests that the U.S. economy dodged the recession bullet, is poised for more growth ahead. Now, this is based on strong data on housing starts that just got released. It's a key economic indicator, and May housing starts were up 21%. It's the highest in 30 years. There's a lot of signals all over the place of positive news, negative news, definitely a mixed bag. But this indicator is kind of a big deal because weakness, not strength, in housing starts is historically foreshadowing recessions. And so you kind of have the opposite going on here, where it's very positive information. Here you've got Mark Zandi, the Moody's Analytics chief economist, just recently mentioned that this time is different. He's betting against a U.S. recession. And he provided 5 reasons. And some of those reasons I'll review with you. The first one is excess savings. He's noting that there was $5 trillion injected into the economy during COVID, and that excess savings peaked in 2021 at a little over $2 trillion. But consumers are still holding about 500 billion of these funds as of May of 2023. Now, I'm a little skeptical on this excess savings. I think it's more of a fear that's in the market, that psychological fear, and that can spread, of course, to consumers, to business owners. A lot of people in general are just being a little bit more cautious with spending. So we'll see where this one goes. The second point he noted, labor hoarding, which is alluding to the fact that businesses are likely to avoid layoffs due to how difficult it's become in finding talent. So somewhat of the opposite of the point we just mentioned on the last slide, but that's the way things are going these days, a little bit of a tale of two stories. The third point I find quite interesting, the light debt loads. And what he's talking about here is, though, although household debt is near a record high, when you compare this with disposable income, consumers aren't typically overly burdened at the moment. He's pointing out that household debt service payments as a percent of disposable income were just 9.6% in the first quarter of 2023. When we compare that since 1980, the average has been 11%. So we're well below that. And then during 2008 crisis, it was around 13%. Now, when you shift gears and you look at businesses, he's also seeing a similar trend where businesses are, I'll just quote him here, devoting a near record low amount of their profits to debt payments, which frees up cash flow. He's mentioning that corporate interest payments as a percent of cash flow are now roughly 7.5%. And when you look at the 2008 financial crisis, it was around 20%. So some interesting points that have caused him to shift gears a bit and mention that he doesn't think there's going to be a recession. He also noted anchored inflation, or inflation going down, and low oil prices, which we just mentioned as well. Another headline here, this is Barry Sternlicht, the CEO of Starwood Capital Group. They're one of the largest apartment owners in the country with over 100,000 units. He just noted that he was a little early with his recession calls. Did not understand the strength of the consumer. Lastly, here we've got the New York Fed. Forecasting gets a lot brighter. What we're looking at here is they're looking at core inflation potentially going to 2.5% by the end of 2024 and down to 2%, 2.1%, excuse me, at the close of 2026. So it's a consensus here that inflation is going to continue to drop, but it's going to remain elevated for the near term. With that, Dan, I'll have you talk about the inverted yield curve.
Yeah, I mean, one of the indicators that we're looking at closely is the yield curve. And when it inverts, it has a very strong predictive value in if a recession is coming. So we currently have an inverted yield curve, which means the short-term rates are higher than the long-term rates. And so it's just, again, something that we're watching closely. It's something that has been really reliable. And so it is something to know.
Yeah, definitely something we're tracking. You can see that drop here in blue below the 0% line. Another important point, I think we'll start hearing a lot more about this in the next couple months or quarters, just the fact that 2024 is an election year. And historically, election years have proven to be strong economically. In fact, there's a recent study here, you can see the screen, but it was I'll just quote here, based on our analysis going back to 1960, we find that several measures of economic activity are actually stronger during presidential election years, including real GDP. So very interesting. We'll see what happens. Historically, election years have proven to be relatively strong from a economy standpoint. Okay, so in summary here, the question a lot of people are asking, is now a good time to invest? And if so, what's a sound strategy? And we do feel that now is a good time to invest because the market is providing us investment opportunities with very attractive risk-adjusted returns. We do think that it's a good time to be very cautious in what we're investing in and how we're investing, really focusing on reducing risk and being lowly correlated to the market. So some of the points that help us come to these conclusions that we've mentioned with you, we'll review a few of them today, but we've already seen discounted pricing versus peak pricing last year. Doesn't mean prices won't adjust further. They could, but we're already seeing a nice discount to that. And so we're not trying to time the market. We know that that is pretty much impossible. We're just making sure that we're making smart investments with very good going in costs and basis. We also have more clarity on interest rate trends now. We think, of course, that we're at or near a peak that will help bring buyers and sellers closer together in the next few quarters. From a transactional standpoint, more deals are likely to get done. We are not anticipating that the Fed will reduce interest rates this year. We anticipate they're going to continue to raise them a little bit more, but all of that is uncertain. If and when they do lower rates, I think we'll also start to see a lot more consensus between buyers and sellers getting transactions done. Another positive, of course, unemployment remains very low, which is a very strong indicator of a healthy economy. And so, again, we're not seeing an imminent crash. We know, again, that it's impossible to time the market, but we think it's prudent to focus on investments that don't rely heavily on speculative growth, investments that can still produce attractive returns in excess of inflation and treasuries. We do think it's best to plan for a recession, although it's not a certainty. And we have always had that in mind since about 2018, when we've been focusing on some of these kind of lowly correlated or inversely correlated strategies. Do think inflation is likely to remain elevated for the near term. We are planning to invest with stagflation in mind, really meaning that if revenues are flat or going up just slightly, but expenses are going up, that's really a situation of stagflation. And we're seeing that across some sectors. Inflation, although it does help raise rents, it also increases expenses. That includes payroll, utilities, insurance, you name it, all of those have gone up. And so thinking about that with a sound strategy is definitely top of mind for us today.